You're listening to the Goldnomics podcast, with new episodes every month on iTunes, YouTube, and SoundCloud. Subscribe to stay informed. Hello and welcome to episode 11 of the Goldnomics podcast, where we look at the global financial markets through the lens of precious metals. And again, this month I'm joined by CEO of Goldcore, Stephen Flood, and our research director, Mark O'Byrne. And just before we start and go over to Mark and Steve, I'd like to remind everybody that they can subscribe to our podcasts on YouTube, on SoundCloud, and on iTunes. And just get everybody to click the notification bell if you are on YouTube so that you can get notified of all of the upcoming videos that we release. And our title of our podcast for this month is 5 Ways to Prosper in the Coming Crisis. And I'm going to start with you, Mark. I'm going to ask you the coming crisis. So specifically, what are we looking at here? What are you talking about?
Well, obviously, our beat and our focus tends to be on finance and the monetary side of things, and that's what we look at on a day-to-day basis and have done since 2003. And we're very clear in recent months and weeks that we believe we're on the verge of a financial and economic crisis. And the question to us is when rather than if. But you can see clearly it's on the horizon, and we don't know the day or the hour, and therefore we're best to prepare now and be ready for it. And there's just so many signals that this crisis is coming. Again, we don't know when, but it is coming, and it's financial in nature, it's economic in nature, it's political in nature, and it's monetary in nature. And it's interesting, all the focus is at the moment on Brexit, and obviously we have this looming event now, March 29th, and the media is focused on Brexit, but there are lots of other risks in the world, potentially bigger risks, including Italexit and the problems in the Italian political system and the Italian banks, and indeed in the rest of the world in terms of geopolitics with Trump and China and the trade wars and tensions with Russia and the unresolved problems in the Middle East. So there's a lot of these issues and little mini crises that seem to be coming together, and ultimately it's a bit, the Brexit thing is interesting because it's almost like there's a political crisis there, which is now having a financial impact on our economies and on markets and on consumers and on confidence. It's creating almost a little financial economic crisis, and ultimately it's leading to slower economic growth. We're seeing that in all the most recent figures that have come out. And now we're seeing the mood music change from the central banks and from the Fed and the ECB and the Bank of England, because ultimately this will lead to, I believe, to a monetary crisis as it did back in 2008, because the response will be again to move from quantitative tightening, which has been the talk of recent months, to quantitative easing again. And you can see very clearly that the central banks are slowly, the messaging is changing, and they are moving from pretending to be hawkish to moving to being dovish. And I think that is going to be a very, very important thing for investors and savers to consider in the coming weeks and months. But the bottom line is there's a huge global crisis there, and it's underlying the whole thing is actually a huge environmental crisis, because all our political systems and our economic systems and financial systems and banking systems are all dependent on the ecology of this small little planet. And we are in the Western world living way beyond our means and have been for a long period of time, while the majority of the planet lives on $1 or $2 a day, and we have this massive inequality in the world. So that's an even bigger sort of global crisis that's there, and I think all these things are slowly coming together, and we're going to see the ramifications of this in the coming months and years, and that's why we think it's important to think about it and not get fearful about it, but just to be psychologically prepared for it, and just to take a few steps you can take to protect yourselves and your families and your companies.
Steve, this talk of crisis, is this just scaremongering that's going on in the market at the moment, or what?
I think there's always going to be a certain sector of society who is, wants to scare people into whatever they're selling. But I think there's also a very, very good argument to say that the modern economic system, that is what we used to know as capitalism, is quite broken. It's no longer the case that work hard, do well works anymore. That social contract is obviously broken. The last time it was so broken was back in the 1930s. So it's hard for people to get ahead. And there's some interesting commentary out there these days about what's called millennial socialism, which really means is that the millennials, which are a growing part of our population, obviously, are probably going to look to right this wrong, to take back assets in doing so, they may actually break the system further, and look for asset confiscation, vote in extreme left parties who really never have and never will understand what capitalism is and how it works, or how it's supposed to work, and how it's supposed to empower the individual to make the most of what the skills that they have and what they and that they develop, and they want to kind of equalize everything, no matter how good someone is or isn't. So I think we're actually playing with fire at this time, and it's as Mark says, it's on a global basis. It's hard to say exactly where the straw will come from, but it is there. It is brewing. Today I spoke to a young fella. He's a trader of 6 years, and we spoke about the fact that the markets are very much gamed. It's hard to know where the risk is, where the liabilities are. It's hard to get ahead of the market and make an informed decision using fundamentals, because there's so much fake money out there coming from bad actors who are creating the political narrative. And whether that be Brexit, whether that be Trump, whether that be Macron or Corbyn or Venezuela, it's very difficult to know exactly where the information is and how to adjust your strategy accordingly. So, yeah, I think we're probably heading towards a financial crisis. I'm not sure where it'll come from. It could come from China, where they've taken on enormous amounts of debt and they're contracting. They have been untested in terms of a contracting economy. But I do think it's probably very much timely to speak to people about, what can they do on a practical level to prepare for this. And there are certain things you can do that we're going to talk about today, and steps you can take that can mitigate the effects. You can't remove them, but you can mitigate them. You can get ahead of this, and we're going to talk about those today.
So ultimately what you're saying is the reality is crises do happen. We lived through one just over a decade ago, and a lot of the risk factors that cause that are bubbling beneath the surface at the moment, and there are other new additional risk factors as well. So you can't time it, you can't predict it exactly. All that you're saying is that risks are increasing in the world, and there are so many new unknown risks that we're dealing with now that we haven't dealt with before, that it's prudent to have certain ways to protect yourself and hopefully prosper during times of any financial or geopolitical crisis.
Yeah, it's true. And this generation in particular, anyone in their between 35 and 50 have actually lived through two massive economic events, which is unheard of in previous generations. And arguably, we've had our balance sheets wiped out twice through market misfires. And people look at those events as singular events. That's when the problem happened, but actually the problem was building up before. It's through poor governance, it's through bad fiscal management, the use of debt, the misuse of debt, and also, and in my view, the biggest reason is apathy on behalf of the voters. People not taking the time to call their political representatives to account. They tend to just kind of leave this to the other guy. Somebody should do something. Well, you're somebody, so you need to get involved and stop these crises from happening on a community level as well.
All right. Well, as the title of this podcast is 5 Ways to Prosper in the Coming Crisis, you guys have given me a list of 5 things. So let's go through them. The first one, Mark, that you've given me is diversify your investments and your savings. Can you talk to that point? It's very obviously, it's an obvious point for some people, but for a lot of other people who get overly concentrated in their investments in one sector, be it property or stocks or whatever, this doesn't necessarily come natural to them. So can you talk to that point for a moment for me?
Exactly. Yeah. Well, it's exactly what you say. People do tend to concentrate and they do tend to focus on what they know. And when they know something, whether it be property or stocks, they do tend to focus on that sector. And the whole maxim of not having all your eggs in one basket, we all know that, and financial advisors and stockbrokers and everybody talks about it. And it's preached from on high, but it doesn't tend to be practiced in many ways, and even from conventional financial advice, balanced portfolio theory today, the majority of the money on this planet is managed on a balanced portfolio basis, which is, roughly 40-50% equities, 40-50% bonds, and a small allocation to cash. So right there, they are overly concentrated in stocks and bonds. So I think my view is in the coming months and years, real diversification will become much more important. And just so people go back into the eggs and baskets thing, so people understand it, because I think people they hear it and they don't actually think about it. What does it mean? So it means basically if you have 20 eggs and you put them all in one basket and you go on your bicycle and the bicycle crashes and the basket falls over, either all the eggs will be destroyed or a large portion of them will be destroyed. So therefore there's merit in having a few eggs in different baskets, and that's ultimately the maximum. It goes back to I think there's actually controversy about the origin of the expression, but it's believed it goes back to Cervantes in Don Quixote, and not having all your eggs in one basket. So it's about diversification, and because there are risks, and what we spoke about before in terms of the system is broken basically because of a variety of different factors, but primarily the biggest issue is the debt, as Stephen said, the huge amount of debt in the system, in the financial system.
Just what's your evidence that the system is broken? When you say the system is broken, what is it that people can look at and see and be able to say, okay, yeah, I see now how it is broken?
Well, yeah, the fundamental figure and fact is the amount of debt in the world, and not just the amount of debt in the world, but the amount of debt in the world versus the amount of the GDP and the trading of goods and services internationally on a global basis. And that figure before, in the first financial crisis, 2007, it was below 200 trillion. Today, it's over 250 trillion is the debt, and the debt to GDP ratio, so global debt to global GDP ratio, is up at 320%. So it's 3 times more debt than the value of all the goods and services in the world traded between every single person on this planet, 7 billion of us, in 365 days. So it's completely unsustainable, and this is in a so-called recovery. So you can imagine when we go into a recession, as happens, all these things are cyclical. We've had a mini boom, a recovery, whatever you want to call it, in recent months and years, but it's been completely generated by ultra low interest rates, by ZIRP and NIRP, zero interest rate policies, negative interest rate policies, and quantitative easing, which is basically the electronic creation of trillions and trillions and trillions, 20 trillion by the major central banks, creating money out of thin air in order to buy bonds and artificially suppress the yield in these bonds, which has created this completely artificial recovery, which is completely unsustainable. So circling back to investments wise, that creates huge risks in the bond market in particular, but to stocks as well, because I think stocks have been artificially supported by the huge creation of this debt, and the debt is not just on the public side, it's also on the private side. Everyone focuses on the US debt of 22 trillion, but the US also has 13.5 trillion of private debt, household debt, so mortgages, credit cards, cars. There's huge debt in the system, and Stephen mentioned the Chinese as well. It's throughout the world, particularly the Western world, but also the Chinese as well, have been binging on debt in quite a huge way, and there's going to be ramifications of this, and it means you need to diversify. And yeah, I think real assets, hard assets, we'll talk about gold and silver, obviously, but and cash is going to be more important, but being genuine diversified. There was a guy, Harry Brown, who had a permanent portfolio theory, and he basically said 25% equities, 25% bonds, 25% cash, and 25% gold. And something like that, actually, it sort of rings truer to me. And I think a strategy like that, I think, will be more effective in the coming months and years.
Okay, Steve. You talked to this point about investing your savings in diversifying your investments and savings.
Yeah, I mean, it's important, eggs basket, that people spread their money around, and you have to also be careful that you don't have the same holdings in different vehicles as well. That's a common mistake that financial advisors will tell people about. They might have multiple.
What's that exactly, or what do you mean by that?
So you might hold an equity fund or an ETF or something like that. It tracks the equity market. You might have an awful lot of exposure to the financial sector, and then you might have another financial ETF that is doubling up that exposure again. So it's important when looking at your overall portfolio to look at the constituent parts of those portfolios. How much exposure do you have to utilities, to tech, to financials, to industrials, whatever you think, or healthcare, and make sure you're not doubling up. But as Mark says, I think it's important that you look at the constituent parts of any portfolio, and you look at the interest rate sensitivity. So if interest rates were to go up or go down, how would that affect your portfolio? And what would you do? And have a think about that. And also,
how would somebody go about doing that? How do you actually go about looking at your interest rate sensitivity when it comes to either your equity portfolio or your bond or your overall investment portfolio?
Yeah, I mean, well, there's plenty of resources out there, but essentially, at first, on first analysis, you look at it yourself in terms of major asset classes such as property. You want to look at that, look at your bond exposure, and see what would an interest rate rise expect to do to that portfolio. And then if you wish, you could also then go further and reserve the services of a financial advisor who would look at that as part of their services to you. But make sure you go with a fee-only advisor, not a commission-based advisor. They tend to be superior. So. But it's important that you again spread your money around. You look at it geographically. You look at it in terms of asset classes, and you try to spread it across different industries as well. And keep it granular, and keep a long-term view on it. Gold is, we're in the precious metals market. We believe in gold as a important part of a diversified portfolio. We've always qualified it on that basis. Gold is not an investment in its own right. It works best when it's in company of other asset classes. And,
yeah, well, I'll actually, with point number 2 that you have, the
yeah.
second way to prosper during the coming crisis, as you've given me here, is owning gold and silver in the safest way possible. So maybe just continue to speak to that point.
Sure,
so this is the second way now that we're looking at.
Yeah, so once you've diversified for a portfolio, you need to give a nod to precious metals, and have them in there at maybe a 5 or 10% allocation at least. And in doing so, what you're doing is you're adding a kind of a layer of financial insurance that really comes into its own in terms of financial crisis and systemic risk, which would have a very deleterious effect on other mainstream asset classes such as equities and bonds and maybe even property. You'll find that gold and silver will really come to fore and reduce the impact of any major negative events on a portfolio. And it's been shown, through lots of research that is the case. That it actually, if you had a 5% allocation to gold, you will reduce volatility and increase returns on a balanced portfolio. And it's very interesting research. It was produced by the Gold Council there recently, and it's something all investors should have a look at. But you definitely want to own in the safest way possible. So having gold in that form, it has to actually have a legal proximity to you, the investor. So it's not really good enough to own it through a complicated fund structure which has at its core asset gold. You want to own it in a segregated and allocated way, and that means basically having it separated from other people's gold in a physical, tangible form that's available for dispatch, transfer, sale immediately, and it's outside of the financial system. Because if you think about it, you're owning gold to hedge systemic risk. You want to own it in a way that those properties are preserved, and so having it inside a bank is not going to really serve you if that bank shuts down because of a systemic crisis. So you want it outside the financial system in a safe jurisdiction. You want to hold it in a jurisdiction that doesn't hold too much debt and in an unsustainable way. So if your country is heavily indebted, then perhaps you want to store it in a different country that's safer, and also one that has a long-term respect for the ownership of assets. And that's a very, very important point, because we believe that as these countries and governments come into a lot more risk and into kind of financial headwinds, they're going to start seeking to acquire assets either from their people or from companies or from their economy through taxes or other means, and they're going to try and rebase their currencies using confiscated assets. So you want to have your gold and silver held in a safe jurisdiction. And of course, at Goldcore, we can help you, understand all your options in that regard.
Mark, do you want to talk to this point now? Owning gold and silver in the safest way possible as a way to prosper in the coming crisis.
Yeah, well, Steve covered most of the bases very well there. And it comes back to the counterparty risk thing. And actually, if I can just go back to the previous point about diversifying your investments and savings, it's not simply about the diversification. It's also about being very conscious of the counterparties and the counterparty risks in the world, because the system is vulnerable. The financial system, the banking system is very vulnerable, indeed much more vulnerable than people realize. The Italian banks have massive exposure, which is going to impact the French banks who've lent into the Italian banks and the German banks and all the rest. All that risk of contagion is there. So you have to think about the actual banks. You cannot take these government guarantees as saying you're safe because there's 100,000 guarantee. You have to think about the actual bank and consider how safe that bank is, And we have clients come to us all the time and concerned about the deposits, very high net worth, ultra high net worth individuals. And privately, we will tell them the banks that we believe would be banks that they should consider putting their savings in, And so that's an important consideration. And that applies even more so on the gold side, because gold is a safe haven asset. All the research shows it, history shows it, the recent financial crisis shows it. Gold is a safe haven asset, but it's only safe if you own it in the safest way as possible. And that's what we specialize in. And as Stephen said, you have to own it in the safest vaults with the safest vault providers in the world and in the safer jurisdictions in the world. And gold ETFs have a huge amount of counterparty risk that many people aren't aware of. There's digital gold platforms that have quite a degree of counterparty risk and liquidity risk and pricing risk as well. And so these are very important considerations that we've long looked at. And in terms of the allocations, we've always said 5 to 10%, and we do think that continues to be the case. That should be your minimum, should be your 5-10%. That's your that's your financial insurance. But given the risks that are out there today, there are grounds for having higher allocations in portfolios. And Stephen mentioned the research from the World Gold Council, and it's excellent research. And it's a shame it doesn't get picked up in the mainstream media, because it really should be, because their latest report, it's the relevance of gold as a strategic asset in 2019. And it basically shows how gold has outperformed most stock markets around the world since 1971, and outperformed most stock markets around the world since over a 20-year time frame, So gold is, it should actually be, I believe, in higher allocations, particularly given the risks there today. So potentially you could have, we had Jim Willie on the podcast recently, and he joked about having 40% of your portfolio in gold. And most people would consider that quite high, but I'm not sure. I think given the degree of risks that are out there today, I think you could have allocations that high. But you have to be careful, and you have to be mindful of the volatility and be comfortable with that. And it's on a case-by-case basis, and
you say on a case-by-case basis. So what would have to either happen in the world, or what would somebody have to be really worried about, or what situation would be required for you to say, yeah, I think you need a much higher allocation? And conversely, then, what would need to be happening in the world for you to say, well, I actually think a much lower allocation is necessary in the situation?
Well, fundamentally, I believe everybody should have a much higher allocation, But I suppose if you're an old age pensioner who's very, say 80 years of age, and you've no children, no grandchildren, then you've no business putting all your money into gold. So there's considerations like that. You really have to look at on a case-by-case basis. But it's funny, we had a very old person recently come on to us saying they wanted to buy gold, and we had a conversation internally here. Should they not? And but if they have children and grandchildren, it's just a great way to pass on wealth to the next generation. So they should have some. But again, you shouldn't be going. There's some people who have come on to us over the years and said, I think the whole thing's going to collapse. I'm putting 100% into gold. They literally would be talking about taking their life savings out and putting it all into gold. And people have no business doing that, But I do think they do have business having, your 30, 40, 50%. 50% would be very on the high side. And you have to be mindful that gold is it's not volatile. It has less volatile than stocks, but there is a degree of volatility, and we've seen in recent years that people who over allocated to gold when the gold price fell, they put too much money into gold, and then they got very frustrated and angry at themselves. So you have to be mindful that gold can fall as well as rise, and that maximum is true. And while we believe it's going to rise in the medium and long term, there's absolutely no guarantees. We don't know when it's going to happen, but the balance probabilities are that equities and fiat currencies and the euro and the pound and the dollar are going to lose value over time, and hence the merits of having higher allocations to gold.
Okay. Now, before we move on to point number 3, which is, I think, a very much misunderstood point and relevant to absolutely everybody, whether it's in crisis times or not. Before we move on to that, for anybody that actually is interested in owning gold in the safest way possible, just have a listen to this message. Because our community understands the potential personal and financial implications of increasing global risks, Goldcore have put together a very special and exclusive offer just for you. For the next 30 days, when you invest $10,000 or more in physical gold or silver coins or bars, you'll get 6 months fully insured secure storage for your bullion, completely free of charge. Goldcore Secure Storage is unique in that all client bullion is held on a fully allocated and fully segregated basis in high security, professionally managed precious metals vaults in London, Zurich and Hong Kong. In addition to the 6 months worth of free storage, we also appreciate that our clients enjoy seeing and holding their metal. And that's why we'll also be delivering to you a complimentary 2019 freshly minted 1-ounce silver bullion coin. You can choose between the world's most popular silver coin, the 2019 American Silver Eagle, or the beautifully minted 2019 British Silver Britannia. And because our mission is to ensure that our clients and community are kept informed and protected, each order also comes with a copy of The New Case for Gold, the fascinating and insightful book by gold expert and New York Times bestselling author Jim Rickards. If you want to protect your financial future, contact us today and take full advantage of this exclusive offer. Just click on the link that you'll find either in this video or in the description below. Own gold and silver in the safest ways possible with Goldcorp, your precious metals specialists. Okay, that's very interesting. And if anybody is interested, you know what to do now. You can either contact the guys through the website, or we'll actually even put a link in the description below where you can find out more information about that offer. But point number 3, avoid excessive debt and leverage. This is something that is relevant, as I said, to everybody, whether it's in times of crisis or not. Steve, do you want to talk to that point about avoiding excessive debt or leverage?
Yeah, I remember my my cousin in Canada, and he's an expert in the property market over there for many years, and he was talking about the bubble that was forming in the last global financial crisis in Canada, and he was saying that when people were buying property because the price of the property was appreciating so fast that it was greater than their own earnings and their own income that they would bring in every year. They would start focusing attention on that and not the fundamentals. And so they would ignore why was property becoming so valuable so fast. And essentially behind that is a credit story. When you make credit too free, too fast, too widely available, and given without any restrictions at all or documentation, you create bubbles in assets. People will start throwing money into asset classes on the basis of capital return as opposed to investment return. And when capital return becomes more important than investment return, or the actual salary that you're on, you have a mania. And again, we've seen this throughout time in history. And you can see it that as up in the last financial crisis, it was the private sector that started issuing debt, driving these markets to bubble territory, and then it burst. But since then, it's been actual governments have actually stepped up and carried that mantle and taken on huge amounts of debt to prop up these asset classes, and which has had a tremendous benefit to the people who own those asset classes. They're in the top 10% of the population, and they have done very well. But they've done it's happened not because of a fundamental. It's happened because of just an enormous amount of money which has been printed chasing these asset classes. So more money chasing fewer assets increases the price. It's important that when you look at debt, debt is a very important thing. Debt's not a bad thing. The use of debt can be bad. Too much debt can be bad, but debt is an important way for companies and individuals to leverage up their balance sheets, to gain an exposure to something that they understand, so that they get an outsized return from that risk that they're taking. And then the idea is that the investment return from that would pay back the debt. But as Mark said earlier, when we have a global economy that's now going from whatever it was 240% of debt to GDP to 320% of debt to GDP, what you essentially have is the beginnings of a Ponzi scheme, where you're getting less return for every debt every dollar of debt that you're printing, and eventually that only ends one way, when people stop believing in the value of the quality of that debt and the value of that GDP. And so that's where we are. Absolutely, we're there now. And I think as individuals, we need to also take lessons from this. You use debt, use it carefully. You want to pay down expensive debt. You want to only use cheap debt. But also in a financial crisis, you want debt that gives you an awful lot of flexibility. that the terms are favorable to you, that the loans can't be called in for any old reason, that the payments that you have to make are known and comfortably within your tolerances, your budget. Should interest rates rise dramatically, you're not going to be exposed. Should you come off a teaser rate, you're not going to be exposed. And you have to understand that the debt that you take on should be only used to buy assets that create a return that more than compensates for the debt itself. And when you start using debt to pay for your day-to-day expenses, or you're living off it, you're in trouble. So credit card debt is a classic example of that. People who live off credit card debt are basically paying an enormous fee for that lifestyle, the standard that they have. So I would suggest that you look at any debt that you have, make sure that it's manageable, make sure that that you can pay off expensive debt, and that you're not living off that debt. That debt's been only put to work for proper reasons, not purchases, but for investments in assets, and that those assets produce a return that doesn't put you at risk.
Mark, avoiding excessive debt.
Well, Steve absolutely nailed it. There's not much I can add to that. I think it's very comprehensive and very good on it. And the bottom line is, in terms of investments, debt obviously is the primary way that people invest in and own property in terms of mortgages, and that's where the big risk is today. One of the biggest risks on the investment side is that we have massive debt on the mortgage side of things, as well as it's throughout the entire system. But it is there in a mortgage system, and the cycle is beginning to turn, and the debt is very manageable while interest rates are near 0%. But as interest rates tick higher, which it's only a matter of time before they do begin to tick higher, and the average interest rate in the last 100 years is 5 or 6%. We're now down near 0%. So how sustainable? You have to look at this and say, right, realistically, in the next 3, 5, 7 years, interest rates are probably going to go back up to 3, 4%. And then you have to say, right, well, how sustainable is the financing, is the mortgages in that scenario? We believe there is a global property bubble. We've talked about this on podcasts and the everything bubble, and that bubble looks to be bursting. I mean, London property price down very sharply, Melbourne, Sydney, down 10% plus, Vancouver, Toronto, China, the biggest property developer in China only last week. They are the biggest property developer in China, and they dropped the prices of all the property by 10%. So the cycle, you can see the cycle is turning already, and that's going to present huge opportunities for people. But it won't present opportunity to the debtors who have themselves up to their necks in debt, because they're going to be finding it difficult to make repayments on these assets that have the value's gone down, the debt remains the same. Potentially the debt and the repayments have gone higher, and they're going to be struggling to get into negotiation with banks and potential repossessions and all the rest of it. So you just need to be prudent about this, mindful of it, and have your ducks in a row, because the value is going to be presented, and the people who have cash and have gold and who have weathered the coming financial crisis, they will be in a position to pick up these property assets and other assets at much better value and better prices.
Right. I'll stay with you, Mark, for point number 4, which is prepare for investment opportunities. What are we talking about here?
Well, I suppose I just segued into it there to a degree that, we do believe there'll be a crisis. We don't know when, but when it happens, and it's hard to know, are we going to have a deflationary crisis, stagflationary, your worst case, hyperinflationary maybe in the long term is quite possible. So, and the nature of the crisis will dictate then how the various markets and assets will react. But the bottom line is there will be a crisis. My own opinion is that's where it will be more deflationary, quite akin to 2007, 2008 in the short term. Then the central banks will react, start printing money, and then ultimately we'll get into very significant stagflation. So the bottom line with that is that you need to, be positioned for it, and by owning higher allocations to gold and silver and cash, you will be in a position to pick up these assets when value presents itself in the coming months and years, and you will weather the financial storm very well indeed. So there's lots of opportunity in the world, you know, and unfortunately we tend to focus on gold as a store of value. It's a form of financial insurance protection. So we focus on these risks because we feel that people don't join the dots. The media doesn't join the dots for people and doesn't give people the context, and then doesn't give people the potential solution to protect themselves and indeed to grow their wealth in these uncertain times. So we do tend to focus on these risks, but I think both myself and Stephen would be optimists by nature. I'm great believers in human beings and our capacity to overcome these crises, you know, and once we take the power back as individuals and as communities, and I believe we will do that, rather than allowing these faceless bureaucrats and unaccountable global institutions that we've given our power to in recent months and years. You know, we need to take the power back. A way to do that is to become your own central bank. Stephen talks about personal sovereignty, and I think that we need to talk about that briefly as well. That it's the system itself is unsustainable, and therefore we need to take the power back for ourselves and our families, our companies, and our communities. And when we've done that, we will be in a position to weather this storm, and not just to protect our wealth, because it's not about protecting our wealth, it's about actually contributing and using our wealth to create the sort of change that we want to see in the world.
Steve, opportunities in the crisis.
Yeah, I mean, like I was just speaking to a client there earlier, and I was just saying to them that, you know, owning gold, whether it be 10, 20%, whatever works for you, the benefit isn't, you know, gold going up, you know, twofold or threefold or to $6,000 an ounce or whatever it's going to do. I mean, we don't know. No one knows. The benefit is actually the psychological benefit of having gold in your portfolio. It'll calm you down. You're not going to lose your head when everybody else is losing their head. You're going to have a clear mind, and then if and when whatever crisis occurs, you will have an opportunity, hopefully, because you won't have too much debt and you'll have leverage available to you because you've put everything in order, and you'll have some assets that have done very well. You'll be able to take advantage of that, and you'll be able to see opportunity, see value, take a long-term view and pick up assets, you know, on the cheap, because other people will be probably panicking and selling assets at far below their real value. So I think yeah, there's always a silver lining to every situation. I think people who own gold have already taken measures to protect themselves and their family, and it goes with silver as well. I know people are always on to us for always talk about gold, but silver is also a big part of this as well, and having both of those metals in your portfolio is important. But yeah, I think you'll be able to pick up things. And obviously, you want to invest in things that you understand, that you have a major amount of knowledge in. You understand how they work. You understand how their cash flows work. You understand where they make money and how they're going to make money into the future. And so you invest in things you know. You invest in things at good value, and you'll be in hopefully a situation to take advantage of those things in the aftermath of any correction that happens.
Okay, well, that kind of leads us into the fifth way here now today. And Steve, I'll stay with you on this. And it's invest in your education, learn and grow.
Yeah, I mean, like it's people overlook this. You know, Mark mentioned personal sovereignty. It's not just a financial concept. It's not a political thing either. It's a holistic approach. You want to empower yourself in almost every situation you can imagine yourself being in, and that goes with knowledge. That goes with keeping good counsel, good sources of information, testing your own biases, educating yourself and re-educating yourself and making yourself relevant to whatever economy that you're in, so that you become a valuable member of your local community where your services are sought out, your expertise is needed, and if things go well, your expertise will command a premium above all others, and that involves you doing the hard yards, taking time out to educate yourself, keep yourself abreast of the facts, and not necessarily rely on everybody else for your information or your decision-making criteria. So, you know, you probably have a speciality. You need to be always investing in that, and you need to constantly expand your horizons, become a generalist in some respects, you know, always be inquisitive, and I say seeking good wise counsel is also important, but be aware that there's an awful lot of misinformation out there these days. There's a lot of people selling a lot of things, and there's an awful lot of very opinionated people, and a lot of the newspapers and where you know, fine editorial columns and fine newspapers have, you know, fallen foul of this and become very politicized. first. So you have to be careful on where you get your news. You have to always have a healthy degree of skepticism, and be asking questions, but also, understand you have your own biases as well, and be willing to probe those and challenge those at all times, and always be honest with yourself, in terms of when you do have those biases.
Mark, invest in your education, learn and grow.
Yeah, so there's no value in this financial crisis happens and the whole thing collapses, and you're in your bunker with your all your kilo gold bars and all the rest of it. You're not going to be a very happy, fulfilled individual. So gold is just a tiny part of the equation on the financial and monetary side, but people need to be looking after their I suppose their personal growth, their personal development, their spiritual growth, and being a contribution to their family, their company, their community, and the way you do that is obviously by everything Stephen said, and there's just so much information and so many resources for people out there today, and so many channels for people to develop themselves as individuals, and to make this contribution. And YouTube is just such a wonderful one example. YouTube is such a wonderful resource, and there's a lot of people I follow on there, and there's the likes of Brian Rose on London Real. He's a wonderful, amazing guests, people who are at the top of their field in terms of neuroscience and quantum physics and huge developments that are happening, and it's just amazing the speed of change that we're seeing in the world, and the old paradigms are breaking down before our eyes, because people are beginning to they've questioned the old paradigms, and I think they're going to create their own paradigms, So there's lots of people out there that are worth following. The two people in particular I'd like to mention is Wim Hof, the Iceman, and Dr. Joe Dispenza. They're just two I think they're the cutting edge of neuroscience, of medicine, and I think they've been, for me anyway, and my psychological health and my mental health and my physical well-being, and ultimately this is all about health. Health is wealth. Ultimately, there's no point in having all the wealth in the world if you haven't got your health and you haven't got your family's health. So I think that should be a big focus for people, and it also helps you be psychologically prepared for these events. That when these things happen, you're not scared by them, and you're both financially prepared, but also you're mentally, emotionally, and psychologically prepared for these events, and you're positioned to just enjoy your life and get on with it, And as Stephen said, you have your goals and you sleep well at night, and it allows you to be in a position to just lead a much more fulfilled life, basically.
Right, so there we have it. They're the 5 ways. So we're looking at diversifying our investments and savings, owning gold and silver in the safest way possible, avoiding excessive debt and leverage, preparing and looking out for investment opportunities even in a crisis. And then ultimately, as well, investing in your own education, learning, and growing. Do either of you gents want to say something just about this? Because really the theme of this is it's personal sovereignty, really, isn't it? You might want to explain the whole idea of personal sovereignty. And I'd also just like to say, because of the nature of what you do in the precious metals markets, you are very keenly aware of the risks that are in the world today, and you believe that it's incumbent on you to make other people aware of it. And sometimes that might come across as being doom and gloom merchants. But really what we're talking about today is very much, it's positive. This is saying, right, well, there are things that may go wrong in the world. There are things that may go wrong in the financial system, but that doesn't have to be negative, that you can actually prosper if you understand this idea of personal sovereignty, which is really about taking back control, ultimately. Would you like to comment on that, Mark?
Yeah, no. Well, you've summed it up quite well, and I think that's basically what we're saying. It's about taking power back, taking control back from the system, and one way of doing that on the financial side, monetary side, is obviously with gold and silver, and it's the personal sovereignty thing. Stephen's come up with the term personal sovereignty, and it's very good, and what will be said for a while is just become your own central bank, you know, in even more simple terms, you know. And the biggest buyers of gold in the world today are the biggest central banks in the world. You know, they're buying more gold in 2018 than they have done since the Second World War. So there's a story in that. Well, why is that happening? People should ask themselves, why are central banks, the people who manage our economies and manage our currencies are buying gold in a big way? Why is that? Just today, the People's Bank of China, one of the biggest central banks and one of the most powerful central banks in the world, announced that they bought gold, and their gold reserve had increased to 60.26 million ounces. So just today, and the Chinese are buying gold every single year, but gold remains a tiny amount of their foreign exchange reserves. But there's a trend there, and that trend is very sustainable. It's going to continue to happen. So if central banks are doing it, why wouldn't you as an individual or as a company do it, you know? Because it's common sense, you know. They know that there are these risks with the Trump White House and the increasingly unsustainable fiscal position of the US. They're worried about the dollar as a reserve currency of the world, and we know how that's going to end. So they are diversifying into gold, and therefore everybody should have a small allocation or a slightly larger allocation of gold to protect against these risks.
Steve, last word to you.
Yeah, I mean, like personal sovereignty is definitely the key concept here, and having gold basically helps you do that. It's like financial insurance. It allows you to be nimble. It allows you to move through your economy. It allows you to be a little bit more self-assured. You can weather more different types of inclement economic weather than other people. Other people might be, in their shorts caught in a hailstorm. You're going to have, proper clothing, and that's what it is. It allows you to be more mobile, but it also says something about the way the world works. You know, the idea that people have to invest in an innate metal that, for the most part doesn't have a huge amount of utility for people who store it, like Warren Buffett said, they store it in a dark place and leave it there. What good is that? There's actually it's an interesting comment, because it's the futility of man, it's the greed of man, it's the ability for us to take our eye off the ball and not call our communities and our systems, political systems, to account, that causes people to want and need to have something like gold, to take back some of that risk or to manage some of that risk personally, because you can't be fully exposed to the system, because the system doesn't always have your interests at heart. Sadly, that is true, and so that is what gold is. It's an unfortunate but necessary part of the modern world and the world we live in, where politicians don't always tell the truth, bankers can be greedy, wink, and sometimes the unexpected happens. They're called black swans. They're tail risk, whatever you want to call it. These things do happen. Most people don't see them, and you tend to have a rush to the exit. So this can have a deleterious effect on your livelihood, that of your family, your community, and you can be left with the consequences for years to come. So unfortunately, it's something no one would want, but you need to have that taken into account and own something like precious metals. That is a currency that's been there for thousands of years, because we've been here before. We've all been here before. We do go through these economic cycles, and unfortunately some people aren't prepared for it.
So that's personal sovereignty and 5 ways to prosper in the coming crisis. And gents, thanks. That's been a fascinating discussion for the last while. What we're going to do as well is, somewhere around here in the video, we'll put a link to that offer that we mentioned earlier in the podcast. There'll also be a link down in the description as well. The link in the video will only be here on YouTube, obviously, but a link in the description on all of the channels as well. So if you want to find out more about that, click on that link for more details, and you'll be able to contact the guys at Goldcore for more details as well, and they'll be able to help you out. But for now, Mark and Steve, thank you both very much. And just to remind everybody to subscribe to our podcast on YouTube, on iCloud, on iTunes, on YouTube, iTunes, and on SoundCloud. Get it right, Dave. And we'll also be on Facebook. Hit the notification bell, and you can also stay up to date with all precious metals news by joining our market update on goldcore.com. So, Steve, Mark, thank you both very much, and we'll see you again next month.
Thank you, everyone.
Thanks, David.
Cheers.
Thanks, everybody.